Welcome to this edition of the Matco Market Brief, where we provide timely insights into key economic developments and what they could mean for your investment portfolio. This morning, the Bank of Canada held its policy interest rate steady at 2.75%, marking the second consecutive pause. In the press conference that followed, Governor Tiff Macklem signaled that rate cuts may be on the table if economic conditions continue to weaken under the strain of U.S. tariffs and if inflation remains contained. He described the ongoing trade conflict with U.S. President Trump as the biggest headwind facing the Canadian economy. At Matco, we anticipate a rate cut at the bank's next meeting, which is on July 30th, followed by two more by year-end. This would bring their overnight rate down to 2%. Now, despite Macklem's softer tone, the Canadian dollar actually strengthened this morning, hitting a year-to-date high of 1.36 versus the U.S. dollar. Now, turning south to the U.S., the Federal Reserve meets next on June 18th, and we expect them to hold rates steady at 4.5%. The U.S. economy is grappling with a tougher stagflationary backdrop, slower growth alongside persistent inflation, which makes rate cuts more complex. That said, we still anticipate one or two cuts this year, slightly fewer than in Canada. This Friday, our attention turns to employment data. In Canada, economists expect a loss of 20 to 30,000 jobs, a notably weak reading, especially given that a healthy Canadian economy typically adds 10 to 20,000 per month. Now in the U.S., job creation is expected to be more stable with 130,000 new jobs forecast. That's slightly below the typical 150 to 200,000 range, but still indicative of moderate strength. Both central banks remain data dependent, so we'll continue to monitor these trends very closely. For now, we do believe interest rates will gradually trend lower alongside a modest weakening of the U.S. dollar. Now, within Matco's diversified income portfolio, we've been actively adding to high-quality corporate bond issues, including recent positions in both Fortis and Enbridge. These are strong names in the utility and energy infrastructure sectors. These bonds carried a 7 to 10-year maturity and offer attractive yields above 4%. Our objective remains clear. Let's continue to deliver stable, tax-efficient income above 4%, even as interest rates trend lower. We've also modestly extended the portfolio's duration to enhance its sensitivity to falling interest rates and further support performance in a declining rate environment. Thanks for watching this Matco Market Brief, and if you'd like to discuss how any of this may impact your portfolio, please feel free to reach out.